Hello students, welcome back. This is Dr. Mercado. Welcome to another lecture of Accounting 1303, Introduction to Accounting 1. This lecture is going to revolve around the content from Chapter 2, which deals with analyzing transactions, the accounting equation. We are using College Accounting Chapters 1 through 27, the 24th edition. Now, the specific problem that we'll be covering in this lecture is problem 29A. Now, I went and I did a thorough review of the problems that I've assigned for homework, and all of the problems for Chapter 2 have a Show Me How video. So that should be very beneficial to you, along with the examples provided within your ebook. Now, I'm going to go the extra mile for you. You will be seeing this problem in your exam, so I have decided to cover it thoroughly with you. That way you understand. Now, if you understand this problem, you more likely will understand the majority of your homework. It encompasses a lot of the criteria or requirements for the other assignments. So this is a comprehensive kind of problem that will teach us how to analyze transactions and post it to the accounting equation, and then ensure that the accounting equation has remained in balance. Now, before I begin this lecture, I do want to remind students that it is your responsibility to read the chapter before you begin working on any of your assignments. Reading needs to happen so you can be familiar with the content. I will cover some areas of the ebook with you in my lectures, but I will not cover the entire chapter. Okay, that's on you to go back and read. Okay, I'm just going to quickly highlight some of the information from the chapter, which we'll be using to complete the problem that we are doing. Okay, so let's jump on to see what we're going to learn in Chapter 2. Okay, so Chapter 2, we're going to learn to define the accounting elements, to construct the accounting equation, to analyze business transactions, to show the effects of business transactions on the accounting equation, to prepare a simple income statement, statement of owner's equity, and balance sheet, and to define the three basic phases of the accounting process. Okay, so now, learning objective 5, prepare a simple income statement, statement of owner's equity, and balance sheet. That is on your homework. I'm not going to put much emphasis on it right now because I will cover that in detail in future chapters. For now, what I do want us to understand thoroughly is how to analyze transactions. If you analyze the transactions and post them to the incorrect accounts, everything will be wrong. Okay, so in accounting, you cannot make mistakes. One mistake is going to trickle down and it's going to affect all of your financial statements. So we need to know and learn how to analyze our transactions and make sure that they are accurate. Okay, so before we begin with the analysis of transactions, there's a lot of information provided. The first thing that we have to do is identify the different components of the accounting equation. The accounting equation is assets equal liabilities plus owner's equity. Okay, so we need to understand what an asset, a liability, and owner's equity are to be able to properly categorize our transactions once we have those transactions available. Okay, so assets are anything that is owned by a business and will provide future benefits. Examples include cash, merchandise, furniture, fixtures, machinery, land, supplies, prepaid insurance. Anything that's prepaid is an asset. Accounts receivable. You need to be able to identify what is an asset. And for me, it's an asset is anything that is owned by the company, okay, or the business that you have. Okay, so a liability. A liability is anything that is owed by the business. This is your liabilities. These are your debts. Okay, so liabilities represent something that is owed to another business entity. The amount owed represents a probable future outflow of assets, usually cash. You have to use your cash to make your payments towards what you owe. Okay, so liabilities are also known as debt. Okay, and the most common of liability accounts are your accounts payable. This is an unwritten promise to pay a supplier for assets purchased or services received, and usually these are short term. Usually you have to pay those within 30 days. Okay, you also have other types of liabilities. I usually like to tell my students if it has the word payable, it means it's a liability. That can be accounts payable, notes payable, mortgage payable, interest payable, salaries payable. Anything that has the word payable, the word payable triggers that it is a liability. Okay? Last but not least, we've got owner's equity. Owner's equity is the amount by which the business assets exceed the business liabilities. The difference between the two is known as your net worth or capital. Okay, and we're going to go under owner's equity a little bit further down, because owner's equity is broken down into different categories. Okay, so assets is anything that we own, liabilities is anything that we owe. Owner's equity is the difference of the two, known as your net worth or capital. Okay, now this is assets equals liabilities plus owner's equity is the standard accounting equation. Now, under owner's equity, we have categories. Okay, under owner's equity, we have an account or accounts called revenues. Revenues basically represent the amount a business charges customers for the products sold or services performed. This is the money you generate off your business, whatever type of business you have. Okay, so usually your revenues, if the service is paid at that moment, they can pay with cash or they can pay with a credit card. Or, you know what, you might provide a service and you agree for the customer to pay you next week, next month, whatever the case might be. Okay, so that's where the analysis begins to happen. What happened? Well, I provided a service. Did they pay me today or are they going to pay me next week? So you start asking yourself those questions so you can be able to determine what accounts it affects. Okay, so expenses also fall under the owner's equity section. So revenues, expenses, and withdrawals all fall under owner's equity. Okay, so expenses represent the decrease in assets or increase in liabilities as a result of the company's efforts to produce revenues. Some common examples of expenses are your rent, your salaries, your supplies, taxes, your utilities, anything of that nature. Depending on the type of business that you operate, your expenses will differ, but basically any money spent for the operations of the business. Okay, so the two main purposes of recognizing an expense is to keep track of the amount and type of expenses incurred and to show the reduction in owner's equity. Okay, so the last but not least, we've got the withdrawals or the drawing. These reduce owner's equity as a result of the owner taking cash or other assets out of the business for personal use. So if you have a business owner and he's withdrawing money from the business, that is known as a withdrawal. Okay, so those are some additional categories. Down here we have the expanded accounting equation. We have assets equal liabilities plus owner's equity. Okay, assets is anything that we own. Liabilities is what we owe. And then under owner's equity, we're going to have our capital account, our drawing account, our revenue account, and our expense accounts. Okay, capital is added, withdrawals are subtracted, revenues are added, and expenses are subtracted. Okay, if you have multiple expenses, you're going to all put them under the expense category. If you have multiple revenues, you're going to put them under revenues. Okay, so this is the expanded equation. So the only one that has 4 different items hitting that specific account is the owner's equity section. You have to remember that you have your capital, your drawing, your revenues, and your expenses that fall under the owner's equity section. Okay. Now, when we do accounting, and I hear this all the time, some students tell me, Miss, I don't want to do accounting because I'm not good with math. Okay. Well, guess what? I'm not good with math either. I still use my fingers and I use a calculator. For accounting, you don't have to be good with math. In my class, you can use a calculator, you can use your fingers, you can use whatever you want to do the math. And we are doing very basic math. Addition, subtraction, multiplication, and division. That's all we're doing. And like I stated, you may use a calculator. What accounting is a lot of analyzing information. Okay. But in order for us to be able to record the transactions correctly, the analysis of the transaction needs to be done correctly. You analyze the transaction incorrectly, post it to the wrong accounts, then you will be providing your stakeholders incorrect financial information. Okay? So when we are analyzing information, we have to talk to ourselves. We have to ask ourselves some questions. Okay? So the basic questions that must be answered when we are analyzing these business transactions are as follows. The first thing we need to ask is what happened. Make sure that you understand the event that has taken place. Number 2, which accounts are affected. You need to identify the accounts, okay? Which accounts are being affected, and this could be 2, 3, 4, 5 accounts. So we need to figure out, some transactions are very complex and they affect more than 2 accounts. So we need to identify the accounts being affected and then classify these accounts either as assets, liabilities, or owner's equity. And then last but not least, how is the accounting equation affected? We have to determine if these accounts are being increased or decreased. Make sure that the accounting equation has remained in balance after every transaction entered. The whole point of accounting is to keep our accounting equation in balance. We must always make sure that our assets equal our liabilities plus owner's equity. If something is off, then at that point we stop and we need to figure out what is causing our accounting equation to be off. Okay? So that is a brief summary of Chapter 2. It does not cover everything from Chapter 2. Please make sure that you do go back and read the entire chapter. Okay, now I'm going to go ahead and I'm going to go over the actual problem. Okay, this is problem 2.9. So we have the effect of transactions on the accounting equation. So we have Swan Nguyen started a business during the first month of April. The following transactions occurred. Then we have transactions A through G. We are required to show the effects of the transactions on the individual accounts of the expanded accounting equation. Our expanded accounting equation is assets equals liabilities plus owner's equity. Under owner's equity, we've got our capital minus our drawing plus our revenues minus our expenses. After transaction G, we have to report the totals for each element, and we have to demonstrate that the accounting equation has remained in balance. Okay, so we're going to tackle one of these at a time. Okay, so we're going to start off with letter A. I'm going to label them here. Okay, we invested cash in the business, $18,000. So the business owner, Swan, okay, just put into the business $18,000. So what is that doing to my accounting equation? Okay. Well, what did we receive from Swan? Well, he put cash into the business of $18,000. So that means I've got $18,000 in cash that I have received. Okay. So my cash is increasing by $18,000. Now, why did Swan put money in to the business? It's because he's investing. He is the business owner. So that means that Juan's capital is going to increase by $18,000. Okay? So the capital increases by $18,000, cash increases by $18,000. Okay? So now you see the equation has remained in balance. My assets are $18,000, which equal to the total or the sum of my liabilities and owner's equity, which is $18,000. Okay, so both the left and the right side must always be in balance. Okay. Letter B. We bought supplies for $4,600. We paid $2,000 in cash and $2,600 on account. So this is a little bit more complicated, and we really have to think what is happening. So to me, I'm going to ask myself, what did I buy here? Well, I bought supplies for $4,600. So I'm going to locate my supplies account. Do I have more or less supplies? Well, I bought supplies, so that means I've got more supplies. So my supplies is going to increase by $4,600. Okay, so the supplies increased by $4,600. Now my next question is, how did I pay for those supplies? Well, it says here I paid $2,000 in cash. So when you pay in cash, do you have more or less cash? I don't know about you, but when I pay something with cash, my cash decreases. So I'm going to go ahead and I'm going to have a decrease to my cash balance of $2,000 because I did pay $2,000 cash for those supplies. Okay. So the next question is, well, that takes care of $2,000. What about the rest? Well, the rest says I paid $2,600 on account. That means that I owe someone $2,600. Which account would we use when we owe someone money? Okay. We owe someone money. We owe someone $2,600 in supplies. So the account that we use for when we owe someone money is your accounts payable. Okay. Your accounts payable is a liability. This is basically my debt. I owe someone $2,600. Now your debt is increasing. You have more debt now. Okay. So now if you look at your accounting equation, okay, I have on my left hand side, okay, I've got a 4,600 increase to supplies minus a 2,000 decrease in cash. So my net effect is $2,600 on the left hand side. If we look on the right hand side, I've got a 2,600 increase to my liabilities. So the net effect is the same. My accounting equation is in balance. Okay. So just make sure that after every transaction, you ensure that your equation is in balance. Letter C. Okay. Oh, sorry about that. Letter C. We paid 1 year insurance premium $1,200. So we are prepaying our insurance. Okay. We haven't used it up yet, but we're paying it in advance. And this is a common business practice. We prepay our insurance, we prepay our rent, we prepay our advertising, a whole bunch of stuff we prepay. Now, anytime you see something that has been prepaid, prepaid insurance, prepaid rent, prepaid advertising, whatever the case might be, the word prepaid is in it, that is an asset. Okay, so we have an asset, we have a prepaid, so we paid 1 year of insurance premiums. So I've prepaid my insurance, so that's going to be an increase of my prepaid. Okay. Now it says that you paid it. Okay. If you pay it, how do you pay your bills? Well, when I pay my insurance with cash. So I have $1,200 less in cash. Okay. So now in this particular transaction, both transactions are on the asset section. We don't have anything on liabilities or owner's equity. Okay. So in this section, one asset went up, the other asset went down. The transaction basically cancels each other. It's just shifting from one account to the other. I took out cash to increase my prepaid insurance. Okay. So that is letter C. Letter D. You earned service revenue totaling to $3,300. $1,300 is paid in cash and $2,000 on account. So you went out there and you provided a service and you charged $3,300 for your service. Okay. The customer said, you know what? Let me give you $1,300 in cash right now. That's all I've got. The $2,000 I'll pay you next week. Okay. We have to record the transaction because you've already provided the service. So let's record our transaction for letter D. It says we earned service revenues for $3,300. So what did we generate? We generated revenues. Okay, so we're going to add our $3,300 of revenues. Now it says here that we collected $1,300 in cash. So because you collected $1,300, that means you have more cash. So $1,300 cash increases. Okay. Okay. And then it says $2,000 will be on account. They're going to pay me 2 weeks down the road or whenever the case might be. So someone owes you $2,000. When someone owes you money, you are going to use the accounts receivable. The accounts receivable keeps track of any money that is owed to your business. That way you can track it and then be able to collect it. Okay, so accounts receivable is you record in that particular account any money that is owed to you and you're going to be collected at a future time. So my accounts receivable will increase by $2,000. Okay, so now if you see on the left hand side, I've got $1,300 plus $2,000. That gives me $3,300 on the left hand side. On the right hand side, I've got $3,300. So I have on the left and on the right both $3,300. And my accounting equation has remained in balance. So that is letter D. Now let's look at letter E. Okay. Letter E. We paid cash on account for part of the amount owed for supplies purchased in letter B, $2,300. So if we recall in letter B, we bought some supplies and we owe $2,600. Well, in letter E, I am making a payment of $2,300. So now we used to owe $2,600. Today, I am making a payment of $2,300. If you make a payment, how do you pay your bill? You always pay your bills with cash. So that means you have $2,300 less in cash. So your cash is going to decrease by $2,300. Now your accounts payable. You used to owe $2,600. We're going to decrease that by $2,300 because now you owe less money. Okay? So your accounts payable will also be decreased. So if you see for transaction E, on the left hand side, I've got a decrease of $2,300. On the right hand side, I've got a decrease of $2,300. We are in balance. Okay, that is letter E. Letter F. We paid the office rent for the month, $750. Any type of expenses that are related to the normal operations of your business, such as the rent, the utilities, anything of that nature, the internet, mobile services, salaries expense, anything that you have to pay to have your business running is an expense. So in this case, we are paying for the office rent of $750. So you ask yourself, how do I pay for the rent? And usually we pay the rent with cash. Okay, so cash is going to decrease $750. Okay, and now what are we paying? We are paying the rent. Now, the rent, if you see, it has minus expenses. Okay, I'm not going to put the minus because it already has it on the equation. Okay, so I'm just going to put $750 for my expenses because it's minus $750. So you have to look at the accounting equation and figure out if you have to add or subtract. And in this case, it's minus $750. Okay, that is letter F. Then last but not least, we've got letter G. Okay, letter G is we withdrew cash for personal use, $100. So the business owner took out $100. Okay, so that's going to happen? If he withdrew money for personal use, that means that I have less cash. My cash decreases by $100. Okay. Now, he took money out of the business. Where do we keep track of how much money he took out of the business? We have an account called drawing. Okay. On the drawing account, we keep track of how much money is being pulled or taken out by the business owner. So here we have, if you see the equation, it has a minus sign. Okay. So it's minus, and we're going to put 100 here. Okay. So cash decreases by 100. The drawing is minus 100 here as well. Okay. So those are all of the transactions. Let me delete this. Okay. Now we're going to make sure that our accounting equation is in balance. To do that, all I'm going to do is I'm going to do a quick formula, and I'm going to sum. Well, let me redo my formula because I'm putting in the wrong one. Okay. So I'm going to sum all of my transactions for each of the accounts, okay? And I'm just going to run it across. So it's going to be that plus escape, okay? Plus, and then this one's plus. This is equal. Okay, and then this is a plus sign. This is a minus sign. This is a plus sign, and then this is a minus sign. Okay, so now I've got my totals for all of my categories. Okay, that is my total. Okay, so now what I'm going to do is I need to make sure that my accounting equation has remained in balance. Remember, what happens to the left side needs to equal what happens to the right side. That is the whole point of accounting, to balance. So we're going to bring in our balance for our assets. For cash, I've got $12,950. For accounts receivable, I've got $2,000. For supplies, I've got $4,600. And for my prepaid, I've got $1,200. So my total assets that I have, which are those four accounts that I have, total to $20,750. Okay. Now I need to make sure that I do the same thing to the right hand side of the accounting equation. Your assets needs to equal your liabilities plus your owner's equity. So we need to make sure that the liabilities and owner's equity together balance the same amount as your assets. So we're going to start off with accounts payable. I've got 300 in accounts payable. I've got 18,000 in my capital account. I've got in my drawing. Now your drawing is a minus, so it's going to be minus $100. Your drawing is minus 100. Okay. Your revenues is plus 3,300, so it's going to be 3,300. And your expenses is minus 750. Okay. Make sure that you look at the symbol for the accounting equation. Okay. Is it add or subtract? Okay. So the drawings and the expenses are deducted. The revenue and the capital are added. Okay. Now that we have that, let me add all of my components for the liabilities and owner's equity. And voila, it equals 20,750, the same amount as my assets. If your left and your right hand side do not equal, that means you're not in balance. That means you made a mistake somewhere and you need to go back and fix it. Okay? The whole point is for us to balance. We need to go back and make sure that whatever happens, on one side it happens on the other, or if it's happening on the same, like for example, this particular case where we had one of our assets increase, the other decrease, we had no effect over here, but these two offsetted each other. So that means that we're still in balance. Okay. So this is the completed problem for problem 29A. It's a lot of thinking and talking to yourself. What is happening? Which accounts are being affected? Are the accounts increasing or decreasing? Okay, and make sure that you always apply the accounting equation or the expanded accounting equation. It's going to be your assets. All of the asset accounts, you have to identify which are your assets. And then that's going to equal your liabilities. This is the amount that you owe plus your owner's equity. And under your owner's equity, you've got capital, which is added. Drawings are subtracted. Revenues are added. And expenses are subtracted. Okay. So those are the components of the accounting equation. And then we just need to verify that the left-hand side equals the right-hand side, which in this particular case it does. So we are good to go. Okay. I highly encourage that you please review the chapter, review the PowerPoints, practice on your homework. You have 2 attempts and I keep the highest grade. The more you practice, the better that you are going to get at it. Okay. If you have any questions or concerns, please do not hesitate to reach out. Please provide me with your step-by-step calculations or what you're doing so I can review and provide guidance. I am not going to give you the answer, but I will let you know what is it that you're doing wrong, what you're missing, or whatever the case might be. Okay? Please, I cannot reiterate it enough. Read the chapter and begin working on your assignments. Refer to the core syllabus to ensure what you know which assignments are due this week. And if you have any questions or concerns, do not hesitate to reach out. Until next time, bye-bye.